Do you guys know what the taxation of air and sea transport business in Malaysia? If you don't know, let me explain. Let's begin by understanding what is meant by air and sea transport. Air transport refers to the transportation of goods or passenger using seagoing vessels on voyages that are undertaken wholly at sea. While sea transport refers to the business in which their income is derived from carrying by aircraft of person, property, cargo and mail by an air carriers or air transport company. Now, let's look at the definition of Malaysian ship. The taxation of air and sea transport business is treated separately from the general provision of the Income Tax Act 1967, with air and sea transport falling under Section 54 and 50. Under Section 54A, subset ITA 1967, a Malaysian ship is a seagoing vessel registered in Malaysia under the Merchant Shipping Ordinance 1952, excluding ferries, barges, tugboat, supply vessel, crew boats, lighter, dredgers, fishing boat or similar vessel. To qualify as a Malaysian ship, a vessel must meet all three conditions. Firstly, it must be registered under the MSO. Next, it must be a seagoing. And lastly, it must not be one of the excluded vessel type. If any of these conditions are not met, the vessel is not considered a Malaysian ship. Next, it is important to understand what is meant by a seagoing ship, as this determines whether the vessel qualifies under the Income Tax Act. The term seagoing ship is not especially defined in the ITA 1967, but refers to a ship that sails beyond port limits. According to Section 2 of MSO 1952, port limit vary depending on the regulation of each port. Therefore, a ship that only sails within Malaysian water and does not go beyond the port limit is not considered as a seagoing ship. Besides that, there is another key concept in the taxation of air and sea transport business, which is the provision on casual costs. So let's see how this affects the way income is taxed. Under Section 54 sub-6 of the ITA 1967, casual call refers to ship or airlines making a call at a Malaysian port where there has been no other calls by the same operator ship or airlines in the past 24 months. If a ship or aircraft is classified as a casual call, this can affect how income is taxed.
The taxation of air and sea transport businesses is in a special class of industry, dealt with separately from carbon charging provisions. Under Section 54 sub 2A, resident operators are subject to tax on a world income basis. In contrast, for non-resident persons, it is on a derivation basis, which covers the outward shipment of passengers, cargo, and charter hire from Malaysia stated under Section 54A sub 3A. Under Section 54A, resident person operating Malaysian ships for transport or charter are eligible for a tax exemption. Although the law states 70%, current Gazette order provide a 100% exemption from Year of Assessment 2024 to Year of Assessment 2026. To qualify, companies must obtain the annual certificate from the Ministry of Transport, proving they meet certain requirements. This includes spending at least 250,000 ringgit Malaysia annually per ship, employing at least 4 Malaysian shore staff who must form the majority of the shore team, and meeting all self-managed certificate requirements for ship personnel. To calculate exempt income under Section 54A, capital allowance for a Malaysian ship are deducted only against its own adjusted income. If there are excess capital allowance or adjusted losses, they are restricted and cannot be used to offset other business income. Instead, these losses and allowance must be carried forward to be used specifically against future income from that same Malaysian ship source. This ensures the tax treatment of Malaysian ships remains separate from all other business activities. Next, I will explain the technicalities of Section 54 sub 3A. First, operator must maintain separate accounts for each Malaysian ship. However, for tax purposes, income from all these ships is treated as a single source. It is important to note that since 2009, capital allowance are deemed to be claimed automatically, even if the taxpayer does not make a claim. Once the exempt income is calculated, it must be credited to an exempt income account to pay out tax-exempt dividends to shareholders. It is important to note that unabsorbed capital allowance and adjusted losses of a Malaysian ship are not available for deduction against other income. They can only be deducted against income exempt under Section 54A. If there is any unabsorbed loss or allowance, it must be carried forward to the following year of assessment to be deducted against the same exempt income source. Even when a ship is disposed of, any balancing allowance is only deductible against the exempt income of Malaysian ships.
Can you explain the difference between tax resident and non-resident shipping operator in Malaysia?
Now, I will explain the difference between tax resident and non-resident shipping operator in Malaysia. For the first taxation, a tax resident operator is taxed on a world income basis. This means income earned both inside and outside Malaysia is subject to tax. In accordance with Section 54 and Section 54A of the Income Tax Act, On the other hand, a non-resident operator is taxed only on a derivation basis where tax applies only to income from outward shipment of passenger or cargo from Malaysia.
Okay, so what about shipping income exemption? Are the operator entitled to tax exemption?
Tax-related operator may enjoy a 100% exemption of statutory income per year of assessment 2012 until 2026, provided the operator runs a relationship and carries on a qualifying business such as transporting passengers or cargo by sea, or chartering the ship on a voyage or time charter basis. However, this exemption is subject to compliance with substantive conditions, including operating expenditure and employee requirements and annual certification. In contrast, a non-resident and operator does not qualify for any exemption under Section 54A and remains taxable on Malaysian-derived shipping income.
How is taxable income computed for tax resident and non-resident shipping operator?
Okay, now the computation taxable income for a tax resident operator income is calculated based on adjusted income after capital allowance, and this allowance are deemed claim even if the operator does not elect to claim them. For a non-resident operator, there are two available methods. The first is the 5% method, where statutory income is deemed to be 5% of gross Malaysia outward revenue with no capital allowance allowed. The second is the ratio certificate method, which apportions Malaysia income based on the worldwide income and requires certification from the foreign tax authority.
Does the scope or registration of ship affect the tax treatment?
For tax resident operator, tax exemption applies only to Malaysian ships, and income from non-resident Malaysia ship remains taxable. For non-resident operator, the ship's registration is not relevant as taxation focuses entirely on outward shipment income from Malaysia.
Thank you for the explanation on residency status. Now let's move on to the next issue. For non-residency and air transport operator, how do we actually compute their statutory income under Malaysian tax law?
Under Section 54 of the Income Tax Act 1967, as license, non-resident operators are given two alternative methods to compute their statutory income from Malaysia operation. These are known as the 5% method and the ratio certificate method. The 5% method contains under Section 54 sub 3, the statutory income is deemed to be 5% of the gross revenue derived from the outward shipment of passenger or cargo from Malaysia. This method is relatively simple because it does not require analysis of worldwide income and it does not require detailed documentation from overseas operations. However, the main limitation is that capital allowance and operating expenses are not deductible. As a result, while the method is convenient, it may not reflect the operator's actual profit position. From a client point of view, it is sound easy, but that means the client might end up paying more tax. It is because the 5% method is based on the gross revenue. It may result in higher tax liability, especially for operators with high operating costs. That is why we also consider the ratio certificate method, which is more precise. As the ratio certificate method contains under Section 54 sub 4 allow the non-resident operator to allocate a portion of its worldwide adjusted income and capital allowance to Malaysia. This allocation is done based on ratio between gross Malaysia revenue and gross worldwide revenue from sea or air transport. To use this method, the operator must submit a valid ratio certificate issued by the tax authority in their home country, which must be acceptable to the Director General of Inland Revenue. Although this method is more complex and documentation heavy, it often results in a fairer and more accurate tax outcome. Public Ruling No. 1/2025 support this approach by reinforce the importance of correct income allocation and proper compliance when dealing with sea transport income. While the ruling mainly focused on the tax treatment of nation ship and Section 54E, it emphasized that income must be computed according to statutory provision, not convenience. This means that for non-resident operator under Section 54, the choice between the 5% method and the ratio certificate method must be made carefully based on facts, documentation, and compliance capability. Which method normally recommend? There is no single best method. We must consider whether a valid ratio certificate is available, the cost and complexity of compliance, potential tax saving, and audit and compliance risks. This comparison taught me that the tax advisory work is not mechanical. It requires professional judgment, support by legislation and public ruling. This is an example question related to non-residency and air transport operator for computing their statutory income.
Thank you for the explanation on tax computation method. Now let us move on to the final key issue. Tax exemption available for Malaysian ship.
The exemption is provided under subsection 50OA sub-9 of the Income Tax Act 1967. It applies only to a person who are resident in Malaysia for the relevant basis year and who carry on a qualifying shipping business. Based on the current legislation and as clarified in the relevant public ruling No. 1/2025, the exemption is granted subject to strict conditions and is computed based on statutory income. It applies only to income derived from Malaysia ship and does not intend to come from non-Malaysian vessel. In addition, the document may also be required for to claim this exemption, such as port clearance issued by the Royal Malaysian Customs Department, document of ship rules, and any relevant document. Two types of quality listed. First, transporting a setting or cargo by ship using a Malaysian ship. Second, lifting of a Malaysian ship owned by the person on voyage, chartered or chartered basis, only income derived from this activity qualified for the exemption. Under the Income Tax Act, 70% of the statutory income from qualifying shipping activity is exempt from tax. However, through statutory legislation, the government has granted a full 100% exemption for the period from year of assessment 2025 until year of assessment 2026. For the purpose of this exemption, the term person includes not only individual and companies, but also partnership. This definition is provided under subsection 54A sub-6 of the Income Tax Act. In summary, this tax exemption is significant simply for resident person operating or chartered relationship. While the law provides a 70% exemption, full exemption is available in the year of assessment 2026, subject to compliance with the required competitive condition from year of assessment 2025 onward.
Is the exemption is applicable under the current tax framework?
Yes, the exemption has been extended through various exemption orders, and for the current period, 100% of the statutory income is exempt by the relevant exemption order, compared with Public Ruling No. 1/2025, reinforced that this exemption is not automatic. Taxpayers must be able to demonstrate full compliance, including proper documentation and certification where required.
Why is this exemption important for our future profession?
This exemption is important because it allows the professional to assist clients with legitimate explaining why ensuring compliance with statutory requirements. It also shows how tax policies support economic development.
What will happen if we are not follow section 54A?
If the client fails to comply with section 54A, the tax exemption may be withdrawn, resulting in additional tax liability, penalties, and possible audit exposure. This highlights that tax incentives come with this responsibility, not this benefit.
In conclusion, from our topic, which is the special cases of the sea and air transport. Please enhance my understanding of the taxation framework governing sea and air transportation, including specific tax regulation and unique tax structure applied compared to other transport sector, and the classification of ship and air eligible for tax exemption. I also learned how ports and unscheduled stock can affect the determination of taxable income. However, some concepts were challenging to grasp, particularly those involving the interpretation of tax law and tax complexity of taxation system for resident and non-resident operator. The limit of availability and simplified resources further contributed to the difficulty of the learning process. Previously, I did not fully appreciate the importance of sea and air transportation of the global economy. This study helped me realize that this sector plays a crucial role in international trade and therefore requires specialized taxation and legal treatment. I also learned that difference in international tax system can significantly influence the profitability of transportation companies, while tax incentive and environmental regulation play an important role in supporting sustainable growth within the industry. One of the main challenges faced was understanding the distinction between residency-based and sources-based taxation for non-resident operators, as well as conducting research and analysis relevant case studies, which require considerable time and effort. Looking ahead, I plan to deepen my knowledge of international taxation, particularly its application to the sea and air transportation industry, to better understand real-world practices. I also aim to continuously improve my knowledge and skill in taxation and transportation through further study and practical exposure. Overall, this project strengthened my understanding of the complexity of taxation in the transportation industry and better prepared me for future academic and professional development.